Well, for more on today's big miss on the jobs numbers, I want to bring in Dean Maki. He's the chief U.S. economist from Barclays Capital. Dean, you are one of the most accurate forecasters in the world. Bloomberg ranks you the second overall on the economy. However, you were expecting a better than expected report.
Yes, this was a surprisingly weak report. And there's no single explanation for the softness. So there is some news here that we have to take to heart. On the other hand, I think we have to also give weight to the other incoming economic data, which have been signaling strengthening activity rather than the softness we saw in the November employment numbers.
So then come next month, could we see a lot of revisions here?
That's quite possible. We are we have been seeing a series of upward revisions, so that certainly would be in line with what we've been seeing today. In fact, we got a 38,000 upward revision, so that could be part of the resolution, but we'll have to see. One never wants to prejudge how data are going to be revised.
No, of course not. Dean, you mentioned something about taking a lot to heart, or taking some of these things to heart. What have you taken to heart from this report?
What this is telling us is that the labor market recovery, which last month seemed to be ramping up significantly, may be just a bit softer than those data would have implied. On the other hand, the trend is still upward. Over the last 3 months, private payrolls have been growing 107,000 per month, and those trends are a lot more reliable than the one-month changes which get so much attention.
So what does that mean then, Dean? Does that mean that we are still on our way to a jobs recovery in 2011?
That is our view. We do think that given the strengthening activity we're seeing elsewhere and the decline in jobless claims, which is inconsistent with today's report, we think that firming activity will ultimately win out and job growth will continue to move upward.
Right, but the question is, when is jobs growth going to get to that 200 to 300,000 level everybody talks about in order to bring down this jobless rate?
We think by early next year we are going to be heading into that 200,000 range. So our expectation is that the jobless rate will start to decline as we move into 2011.
So you haven't changed at all, you haven't delayed it at all with this report?
That's right. We do think that turn is coming, and what convinces us of that is the other incoming economic data. Whether one looks at the ISM surveys, the GDP-related data, consumer spending firming, all of that is signaling that the economy is indeed picking up.
But Dean, you know, we were listening to Bill Gross earlier, and he's raised this point, as the Fed, in fact, has also raised this point, which is, are we not perhaps in a moment in the United States where we are seeing a structural change in the jobs market?
We do think there are structural changes going on, and in fact we are going to likely be in a period of elevated unemployment for quite some time. At the same time, we don't think that means that the unemployment rate can't fall from here. There is a lot of cyclical rise in the unemployment rate as well as structural, and that cyclical rise should start to reverse as the economy picks up steam next year. So
this high unemployment rate, for quite some time, describe to us what that scenario is going to look like.
We think the unemployment rate will gradually be declining by about a percentage point or a little bit more over the next year. So that's our expectation. Even at the end of next year, unemployment is still going to look elevated relative to recent history.
Dean, how does your outlook change, your forecast, if we do get an extension of the Bush tax cuts?
If they're fully extended, we would likely be bumping up our forecast a little bit. We're assuming most of those tax cuts do get extended. If they all do, then that would call for some upward revision. On the other hand, if
from where to where, though? Just tell us from where to where.
Roughly 0.2 for all of next year would be our expectation.
Okay.
A 0.2 upward revision. So we would likely go from something like 2.8 up to 3% or so. On the other hand, if they all expire, as the current law says that they will, then that would lead to a significant downward revision, something like a percentage point.
1 percentage point out of
exactly.
GDP from that.
This is a large amount of money we're talking about, so it is quite important what happens in Washington over the next couple of weeks.
Dean, thank you. It's good to talk with you, as always. Our Bloomberg Best and Barclays chief U.S. economist, Dean Maki, talking about the jobs report and the economy.